line, and I'm Nivedna Prabhu. Let's begin with our top focus. The SEBI Investor Survey 2025, in fact, has uncovered a striking paradox in Indian investing. While awareness of securities products is at an all-time high, with 63% of households knowledgeable about them, risk aversion, market complexity, and persistent trust issues keep most of the sidelines. That is, only 9.5% of households participate, meaning just 32.1 million of the 213 million aware households are active in the market, leaving a vast pool of retail capital untapped. That is, in fact, you're looking at the essential numbers playing out on your screens at the moment. But to decode that further, let me take it across to my guests who join me this evening. Sunil Subramaniam, market expert, as well as Dhananjay Sinha, co-head of Equities Systematics Group. Good evening, gentlemen. Thank you very much for taking the time out. It's always a pleasure to have you on our show. But Mr. Subramaniam, let me begin with you. These numbers, 62% of retail investors follow influencer advice, that is. But I want to understand, while of course you will give me your perspective as to what you really make of that survey as well, does this signal democratization or a risk of herd-driven, uninformed investment decision?
I think it's a mix of both. I think that what's happened is that if you take away the last year, right, post-COVID, I think equity markets have done phenomenally well, right, in terms of generally giving very good returns. You can see from the SIP penetration numbers, which have gone from about 10,000 crores per month to almost 30,000 crores, 28 to 30,000 crores per month now. So clearly awareness, and for this, you must credit the campaign that AMFI has done called Mutual Fund Sahi Hai, which has used celebrities to bring the awareness. So this level of awareness that is there today is far higher, I would suspect. I don't know if you have similar data about that, definitely there. But as you said there, what this kind of wealth creation that equity market have done has also tempted a whole bunch of people who are used this new gen F&O options have come in, small cap stocks and the exchanges, the number of small cap IPOs have shot up over the last few years, and this desire to make a quick buck. So obviously there is a section of the population who are, I would like to use the word gamblers in that sense, right? You can use speculators for the stock market, but the nature of the thought process is one section of the population likes to gamble. So whether it's in the lottery, go to Goa or Kathmandu for a casino, or it's playing Teen Patte, there is that. So to that population which is attracted by these returns, fin influencers have stepped in rapidly and have get rich quick schemes have become very appealing. And so while the penetration levels are still low in terms of mutual funds and equities, whoever is penetrating is tending to do this because it's the get rich quick which is attracting them, right? So I think now there's a huge responsibility on us as a nation, as manufacturers and distributors, that we guide these people properly, that equities as an asset class can be a very good wealth creation, inflation beating asset class, but it's not like a lottery where you want to just go and try your luck. I think there's investor education comes out at the forefront of what needs to be done as a result of this survey. And I would encourage the fact that distribution is key, because the lack of trust in financial institutions, that was a bit surprising to me. So despite the fact that you have the State Bank and the HDFC banks, big banks in the mutual fund space, this lack of trust being expressed, which means that a personal level relationship is also probably critical. So the mutual fund distribution committee, I think, has a huge responsibility.
So that is the missing piece in that particular puzzle. Yes. Absolutely. In fact, as you put that into perspective, Mr. Subramaniam, I'm going to come back to you and decode that further. But Mr. Sinha, coming to you, despite this 63% awareness of securities, we're only looking at 9.5% participation. From your vantage point, how are we looking into this?
So I think the thing is that there is awareness that has been there. I think that's largely in the context that there is a significant digital penetration that has happened, and because of which people do have exposure to media content, which basically talks about how equity markets been doing very well. And we have seen a wealth creation happening. If you look at the market cap to GDP, it has increased pre-COVID from something like 80% to almost like 130%, now about 120% in FY24. So I think that kind of sort of awareness, that kind of buzz around how people are actually making money is there all over the place. However, if you look at the awareness versus participation, I think that is, 10% versus, let's say, 65%. So that basically also tells that while people are getting aware, there is considerable amount of skepticism about how returns can be made. There is, if you look at the survey data that you have sort of shared, it does look like people are scared about losing money. They want to conserve capital. So I think all those things are there. And quite importantly, if you look at 10% people who are invested, whereas the GDP market cap to GDP is 124%, there's a moderation in FY25. It tells us that there's a high concentration of wealth within 10% of the family, 9.5% of the family. That's quite a startling, I would say, disparity in terms of the wealth that people might be owning. I think one has to also consider the fact that a lot of high net worth people or corporates who are investing into equity markets have been able to bloat the valuations quite considerably, and hence there is a possibility of bloated paper money and paper wealth all across the households. So there is a considerable amount of disparity, I would say. Awareness, of course, has been created by mutual funds, and there is a considerable amount of campaign that has happened. That's growing rapidly, but I would say that there is a fairly high amount of concentration of market capitalization going to very select segment. Within that, I would say 9.5% that is there, it might be very concentrated. So I think that's an important thing. If you look at global comparison, that market cap is quite expensive compared to other countries. If you look at China, it's half of what we are. So I think there is a certain amount of bloating of valuation that people are concerned about. And we are also seeing in the survey that people who are educated, who are postgraduate or graduates, they are more exposed. Urban guys are more exposed. Rural guys are lesser exposed. So it's also linked to the profile of education. So that also gives you a sense of where the wealth is getting created. So you need people who are more aware. They're more educated. They're
right.
aware.
So that essentially about
yes.
the education aspect, which I want to come back to you as far as that is concerned, at least on that bit. But Mr. Subramaniam, what I want to draw your attention to is how we're given to understand the Gen Z segment is aware but cautious. Now, of course, while you decode that in your own perspective, do you see them becoming active investors soon, or will risk aversion persist despite financial literacy?
So I would say that, risk aversion is not related to literacy. Okay, first of all, risk aversion comes from the nature of you as an individual, the family background that you're in, how your parents have been, how you've been encouraged to take risks from childhood. So I think that the fact that the Gen Z also 79% are risk averse indicates that the parents have basically educated the children about leading safer lives and not taking too much risk in that sense, which as a moral thing in the country is not a bad thing. And I would throw the spotlight saying literacy, more financial literacy means what? You can't make a risk averse person suddenly become risk tolerant, right? The basic nature you can't change. But what you can help them do is to learn to take managed risks where they protect the downside while trying to get some of the upside. And that's where I would now put the onus on the industry itself, and especially the mutual fund industry, that this is the Gen Z is also saying that they want safer and simpler products which they can understand. And so I think that the industry also already has debt products, liquid products, hybrid products, which are geared to manage the risk reward ratio in the favor of risk as compared to reward and launch it that way. But those have not been marketed. What's still being marketed is the sectoral funds and the high risk funds, right? So to that extent, the more we push those kind of products broadly, these people are going to get averse and say, oh, I don't want to take a risk. So this survey has been very useful. The general perception, right, and I can see it from the surprise in your face, is that Gen Z means they take more risk. No, it's not that. You can't categorize all the Gen Z. Gen Z are products of the Gen X or Gen Y or
Fair
Gen
point,
A.
Mr. Subramaniam, but let me interject you there. What I Right. Fair point that you make there. But I want to understand from both of you, but let me take that back to you, Mr. Subramaniam. How does this also reflect on the Indian economy and the nature of income of majority of Indians, that is?
No, I think my other co-panelists had referred to this, right? If you see the income polarization, 10% of the
Yeah.
population of India controls 60% of the income. And if you go to wealth, it's even more concentrated. 1% of the population controls 40% of the wealth of this country. So there's a huge amount of income polarization. But then in the survey today, I didn't see the number about the values. It was about number of people. So I think that to that extent, even if you have little money, the SEBI is also now promoting 250 rupee SIPs, right? Sachetization of products. So I think that mutual funds and equities can be for every type of earning population, even the low end. But the point is, you need to have the right risk-based products. So not everything can be 100% equity, right? Can have blends of equity and debt to manage that risk. So I think that that's the key. I think the lesson from this is that as an industry, everything, we need to make sure that we provide safer products which address the risk aversion that both Gen Z and the other regular population seems to have. And I think along with education, and so the education itself is not just about saying, oh, equity markets can beat inflation in the long run, but in the short term, there's volatility. But to say that there are products which can manage volatility and still deliver a decent return may not be as high as you wait for 10 years in an equity product and you get double-digit returns. It may not be that strong. But I think that the nature of education, which I think you pointed out Nivedana, earlier, that the nature of financial literacy education is to tell them that the entire equity market is not just a whole high risk entry. There are products which blend equity and debt, which can manage the risk reward in your favor. So that kind of education as part of financial literacy is important. Whereas right now we are actually tending to focus on saying retirement planning. You have MS Dhoni coming saying retirement claim, mera plan ho gaya. Means in the long run, yes, equity market delivers, but the short run there is volatility. So now we have to take the bull by the horns and address that issue also to the investors. So I'm saying they're talking to us through the survey, and we have to listen.
Yeah. And I think perhaps you put that very aptly, Mrs. Subramaniam. And given the fact that probably taking cue from what you said, it's ultimately that permutation and combination which will help in the outcome of what we're looking at over here. But let me take that to you, Mr. Sinha. Given the survey insights, I also want to understand what strategies can help bridge the urban-rural divide as well. And of course, at the same time, encourage meaningful participation. This is across all household segments.
So I think, see, the thing is, awareness is one side of it. I think as the survey is telling, the awareness is very good. I would say if 65% of people of households are aware, I think there's a good amount of progress that has happened from an awareness standpoint. As I said, it is largely driven by the digital media, also by TV media and other media stuff. There is good amount of campaign that mutual funds have taken through. I think all those things are there. I think the startling part is that notwithstanding that awareness, the conversion is not happening, and it is quite apparent that all these campaigns have not been able to convert good enough participation in the equity market or the security market in general. So that is important. I think this will happen over a period of time because eventually people will realize that they will need to plan for the retirements with the cost of living going up. It's quite likely that the burden of retirement, wealth that you require will be significant. So I think this awareness, along with more credibility of return ratio, the stability of the return ratio, return profitability, etc., will need to be demonstrated by the mutual funds and and companies as well in terms of their earnings, etc. So I think as that sort of permeates, there can be more participation. But importantly, the other aspect to really understand is that it is quite possible that this disparity of rural, urban, and versus educated and less educated essentially also is linked to the average income level. So if you look at the income tax data, it tells you that the average income of salary earners is roughly about 8.2 lakh per annum. And that's quite little in terms of the cost of living, especially even in the urban area. Even in the urban area, if you look at the survey data, it shows that that participation in urban areas is roughly about 25%. So clearly, it is also to do with the income situation. On a CAGR basis, if you look at last 10 years, the increase in average salary of income tax return filers is roughly about 5 to 6%. That's hardly beating the inflation. So you need to have a more robust expansion in employment generation, income generation, etc. And I think that is more
Right.
significant at a broader level if you look at the rural areas.
Right, and that's perhaps what will set the foundation more strongly in terms of that story unfolding. But Mrs. Subramaniam, I quickly want to get your perspective on FNO as well. And given the fact that what the survey has looked at, and of course, Mrs. Subramaniam, if you would also like to counter that particular point, but with
No, it's
FNO
not
aspect
a
of it.
thing. I think I also read the survey in a little more detail. And three other things came through in terms of what the people who are not investing said they want. So first is they want communication in a simple and easy manner, right? One, but in their rural language. So I think probably as a system, we are not reaching out. Maybe we still stick to, let's say, a Hindi and a Tamil and, a certain, but there are languages like Bhojpuri, for example, or, the deeper languages of India. So maybe the comfort with the language that I think came through in the survey. That's one. Second aspect here is the trust in the financial institutions. So I think that here probably the banks, because I think banks are trusted and most banks are today distributing mutual funds and have securities platforms, right? So I think that they should be in the forefront of building the trust in the rural population. And the third point I want to make, which is not covered in the survey, but I've seen data elsewhere, that 53% of India's thing is in real estate, household savings, and another 12 to 13% is in gold. So you're talking about 65% is in physical assets, and only 35% is competing in the financial basket, and then they are risk averse. So naturally, there a bank deposit and a post office savings scheme gets priority, and that's one of the reasons for the low rural penetration. So I think that we also have to address the fact that gold can be invested in a paper form through mutual funds. REITs give a good option to invest in real estate through a paper form. So maybe those kind of products also need to be brought because they comfort with that asset class, but in a paper form, maybe a easier barrier to break through. So these are suggestions in terms of what we need to do to your question on the rural penetration being so much less than the urban. It's probably a mix of these factors. Now, coming to your point on
Right.
F&O, right, clearly, the 80% of Gen Z also wants to be risk averse. So they're not there. From the balance 20%, right? The awareness of F&O overall as a population less than 1% as per the survey. But because we are a 140 crore population, that 1% represents a huge number of people who are trading in F&O. And SEBI's another study showed that 90% of the people are making losses. Now, like I said, this comes through from more of a gambling, get-rich-quick kind of a process. And influencers are obviously quite good because post-COVID, social media has exploded digital penetration. We have a 65% mobile phone penetration, and cost of data in India is the
Absolutely.
cheapest. It's $0.1 per person. So I think that social media is a very important thing where F&O gets access by the influencers. So I think that
That
the
is perhaps the
communication
glue
from the
that is
regulator,
right,
AMFI,
kept
also
everybody
should be more.
together. But Mr. Subramaniam, you make very compelling points. I wish we had more time to be, continuing this conversation. But we have, of course, captured all your insights, and rightly so. But Mr. Sinha, you as well, thank you very much, in fact, to the both of you for taking the time out, joining us here and sharing with us more perspective. Perhaps it calls for another conversation very soon, but for the moment, we leave it at that because we're slipping into a quick break here on Business at 9. Stay with us. We're going to be right back with lots more on the other side.